This is a very short video related to the post that I just wrote that you're going to see above this video, and this is just explaining how we think about modeling the future path and the direction of the equities. Let's read off this post and then just break it down piece by piece and plot it on the SPX chart and what we think is most likely outcome. The map of upcoming events is significant. VIX, OPEX 17th, very large single stock expiration as well on the same date. CPI report on Thursday next week and QRA announcement on the 29th. So let's break it down. Positive structural vanilla and charm flows are slowly dissipating. The closer we get to the expiration, the more and more of these flows are going to come in and out of the market, and the market just naturally going to be more and more vulnerable and open to the fluctuations. Let's say it like this. These flow on the trading basis for SPY, HYG, GLD, EWW, and a lot of world equity names, a lot of things that are generally negatively correlated to the dollar and the rates. All of them have broken its trade support, and it is significant. It points to a continuous weakness over the next 1 or 2, 3 weeks at least. So we have to keep that in mind. These flow dynamics, along with our signal, point to the window of weakness forming in the near term. Near term meaning these 2-3 weeks on the trading basis, essentially. These flow and markets are vulnerable, and the next move will be a derivative of what will happen with the CPI and QRA. QRA will decide the fate of the underlying liquidity for the next 3 months, so it is more of a question of what is going to happen on a trending basis, what is going to happen for the next 3, 4, 5, 6 months, and QRA is at the end of this month, so let's just leave it at that. Let's not talk a lot about the QRA and its potential impact, because it's still very far away. Let's just manage the CPI, which is a lot closer. CPI and the VIX expiration. And CPI is just adding more volatility, but we don't believe that the CPI report of the Fed, or the Fed reaction is able to change the direction of the underlying positive trend, meaning what I'm talking about. This is where we stand currently. This is the tail support that we have, and this region is the trend support. Let me change the color. This is tail, this is trend. What do we mean on a trending basis? We say that CPI is unable to change the direction for the indices, to change the direction for the dollar, to change the direction for gold, for credit, for rates on a trending basis. Meaning that for the next 2 to 3 months, the underlying dynamics are positive, and we expect a high highs on a trending basis for SPX. This means that every single break in trade is meant to be bought. Every single retracement is meant to be bought on a trading basis. These retracements and rebounds on a trading basis can last long, 2-3 weeks, maybe a month, maybe even 2 months, but eventually this is the time to be buying on dips and not be shaken out by the volatility. And CPI, why do we say that CPI is unable to change the direction or impact the market on a trending basis? Just because the range of probable outcomes is very narrow compared to what we had previously, when the CPI reports could change the trending basis entirely, like it was, for example, right here, like it was, for example, right here, or right here. There were plenty of times. Not this time. The range of probable outcomes of inflation in inflation itself, in the inflation data that we're going to be getting, is comparatively smaller than we had in previous times, and therefore the Fed reaction is going to be much more muted. And they already set out the trend of their potential policy. Now it's just the variances. Are we going to price in 25 more price out the cuts, or price more cuts in or not going to price anything. So essentially, it's just the dynamics in between. No cuts in March, or maybe we start cutting in March, maybe we start cutting in May, maybe we're not, and this fully depends on the CPI and the reaction of the Fed, and this is what the market is pricing currently. We are pricing 150 basis points of cuts for the 2024, first cut beginning in March of 2024. This is an extreme outcome. We wrote about this in this post. Let me open this up. Nope. Yeah. Here's the market pricing for the future policy rate in major economies, amount of cuts and the distribution of those cuts throughout the year, plus that dot plot. Medium dot plot projections are for 75 basis points of cuts for 24. The most extreme outcome is for 125, 150. Market expectations are in line with the most extreme outcome currently. This is the dot plot. This is the medium. Medium is for 475, for 5, and the somebody voted for less than 4% by the end of 24. Where are we? Yes. The point is that the recent massive easing in financial conditions, balance and productivity, favorable outlook for liquidity over the next 3 months, potential stickiness of inflation in and around current levels, all point to the rising probability that we are going to price out some of the cuts in the first half of the year and maybe shift them into 25. The point is there is a good probability that inflation is stabilizing in and around these levels that we have currently, that it's not getting back down to 2% and stabilizing in around 2.53%. Is that acceptable or not? We don't know, but on a relative basis, this can influence the market on a trading basis, meaning, let me find this SOFR. What we proposed is to short the September SOFR futures with the stop, that's 25, that's September, with the stop above 95.90 and the potential target at 95.50. And this is the trade. This is the trade that balances the book very nicely. In and of itself, it is a nice standalone trade. We believe there's a higher probability outcome. We will see what will happen with the CPI and the reaction. And it's a very nice trade to balance the book. If you are preparing and accumulating equity longs on a trending basis right now, buying the SPX, let's say, SPX is gonna go down if we are gonna price out some of those cuts, and this will balance the book very nicely. Very tight stop, and in itself an asymmetric position. We entered. Now we have a risk reward down to 1 to 3, something in that region. Not incredible, but not bad, and within the current context of our portfolio, it does make sense. This makes a lot of sense, and now let's back to SPX. So this talks about the variance on the trading basis. Just with SOFR futures, just with the dollar, this CPI will likely to cause volatility within the trading basis, on a trading basis, meaning that this is your trading range, and everything can happen in here. I mean, literally everything can happen in here. These are your boundaries, and I believe that this is very, very unlikely that we break or even test 45.30, 45.50, but there is a probability of that happening. But the direction for this SPX is going to be within this range over the next 2-3 weeks, probably by the end of the January. Is going to be decided by the CPI essentially, and we do expect weakness regardless of the CPI. It might cause a pop up, but we do not believe that the CPI is going to be an event that will be able to take us higher beyond the previous high that we installed right here. So it's just a trading event that is meant to be traded as an event. That's it. But we do believe a weakness and consolidation in store for SPX and equity overall over the next little while. CBR report that reaction changed the line positive trend. It adds more variance through the change in forward pricing of rates, but the range of probable outcomes has tightened significantly, and whether we are going to price out 25 basis points or not is mute, unless the number is completely outrageous, obviously. So CPI should be traded as an event and only on a trade basis, and within the trading range. And since the report is on Thursday, if one wants to trade the event, it would be very prudent to put off making a decision until Wednesday, because the closer you get to the event, the clearer the picture of the underlying positioning gets. The QRA, in turn, has a chance to impact the trending direction, but we believe that the report will be positive or at least neutral. Everything is dependent on the rates, and everything is correlated to them, currently on a trading and trending basis. Rates are in turn dependent on the future pricing of Fed policy, which we just talked about, which in turn depends on the economic data, employment CPI, ISM, so on, and supply and demand dynamics in the treasury market, QRA. You get the rates right, you get everything else right. Blah, 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 blah. That makes sense. The underlying picture is as such. We are positive on the trending basis in US equities across the curve, every single sector, everything. Nothing points to a significant move to the downside currently. In credit in Europe, in credit in Europe, in equities in Europe, in equities in Asia, in equities in emerging markets, everything has shifted into the positive trend and tail on a trending basis. This is unbelievable and positive setup. The worst case scenario that we can get right here within the equity space, we believe this can be initiated by the CPI or anything else. But the worst case scenario is this thing happening again. We entering into this. We've just discussed this, the window of structural weakness of flows, and has already shifted into the negative trade territory, and this points to a continuous correction in SPX on a trading basis. This might last. This time it lasted, 2 months approximately. We've just stood in consolidation. Same thing might happen right here with different range, different volatility, but overall we would expect in consolidation within that range, and sometime in the first quarter or the second quarter of this year, or the beginning of the second quarter of this year, we believe that we will exit this range and continue marching onward. This is the underlying trade that we're focusing on right now. On a trending basis, you want to be long the equity. You want to be long whatever equity that you want to be long, but this is the best trade on a trending basis. This is the best position that you can take on a trending basis. Get long of the equities in whatever form that you like. As I wrote here, you get rates right, you get everything else right. Just let me put this on once again. Let me put TLT on, and let me put the Dixie on. This should be quite clear. And let's turn on the daily chart, and let's invert the Dixie. Let me invert the Dixie. I cannot do that. So I just don't know how to do it. But the point is, this is the. Now there's going to be very crowded. I'm sorry. Let me change that. Let me change Dixie to the 10-year, and let's just delete the TLT as well. Let's just look at the rates and just visually confirm what I said right there. You get rates right, you get everything else right, and since the beginning of the 2022, every single move on the trading and trending basis has been all about rates. every single time, all about rates in dollar, meaning in currencies. Some commodities are somewhat correlated, but well, they per usual trade with in almost in its own world fiat alternatives like Bitcoin and gold, same thing. Equities, same thing. Well, essentially, world equities, everything in the world is correlated to the SPX, and SPX is correlated to the US rates. So, yeah, everything is correlated to rates. And let's break this down just a little bit so we can see this. And what we expect for rates. This in 2023, from the beginning of the 2023, we've been in a consolidation on rates right here. This was a pretty volatile consolidation, and therefore we've seen this in SPX, right? In equities as well. Look at this. Rates coming lower, SPX grinding higher. Rates starting to rise, SPX starting to fall. Rates starting to fall, SPX starting to rise. Rates fall significantly. This was your SVB moment. Rates fell, and SPX right here. This was right here, and this was the time when we had a perceived credit event, and SPX and credit exploded and fell as well. But at the end of the day, what did the Federal Reserve do? We know BTFP, and therefore everything they resolved everything very quickly. And after that, more liquidity, more underlying liquidity, and we posted the an update on liquidity, and we say that liquidity will be very positive in the first half of this year. At least not negative on the margins, positive. And the next QRA will be very significant. That's why we're saying that the next QRA will be widely significant. And interesting hints that can be that the Federal Reserve gave us in the latest minutes update and release that they did when they said that they're thinking about the slowing down the pace of balance sheet runoff, and that is interesting. I believe they will have no choice but to cancel the QT entirely, but they choose to do it in steps. Now, this means that they see this problem in supply and demand dynamics, and it looks like they're acting proactively in order to keep the bank reserves ample. And this is what they did right here. When we have any sort of credit event, now we know what happens right now. Yeah, every single time. Here you had your, we're all gonna die, and amazing cuts priced in, and Fed extended liquidity, essentially did QE, create the new program, a BTFP program, and what happened? Ample reserves, ample liquidity. We are coming back up in equities. And this is what they are doing currently. They are maintaining the ample reserves, and they will do everything in order to maintain the ample reserves, even if it means stopping reversing QT entirely. We can see the hints of that. But the point is, at this time, rates. This was a very interesting moment for us right here. Rates, when we had a break in relationship in between the SPX and the 10-year and the rates overall on a trending basis, this was this moment. This is the moment when rates shifted into the positive trend territory, meaning trending higher, and we called for long in rates, short TLT. This was our main trade for the end of the summer and beginning of September and beginning of the autumn. Short TLT, short TLT, and long rates. This is essentially what happened, but this was very interesting. In that time period, first half of 2023 and second half of the 2022, the correlation between rates and equities were spot on and perfect, absolutely perfect. Incredibly sharp rise in rates, fall in SPX. Fallen rates, rise in SPX. Fallen rates, rise in SPX. And right now, right here, in that time period, I'm pointing to this. we shifted because of the liquidity, because of the ample liquidity and the reaction of Federal Reserve. We've shifted into the positive trend territory on SPX. At the same time, we've shifted into positive trend territory on rates. We've been calling for long rates right here, and at the same time, we've been calling for long on SPX as well. And this is essentially what happened. Even though rates began to grind higher, SPX did absolutely nothing to react to this. It kept going higher. This is just normal positioning. There's just normal flows in the market and normal desire of the market just to go up, essentially. And we've had right here a very significant level. Let me delete the 10-year right now, US 10-year. That we've been beating into. This was the trending resistance that we had in the market, very significant area, and a couple of times we ran the trend support, and we've been calling for long, and essentially we did. We then finally broke it, and where did we run into? The tail resistance, as we called before it even happened. This was our target, the tail resistance, and this was your tail resistance. And we stop right here. Then was the next QRA announcement, and the correlation in between rates and SPX has returned. And now, in that time period, we've, at the same time as we calling for short TLT, this became pretty, in and around that area, it became pretty obvious to us that this will be very negative for SPX on a trending basis, because rates are likely to shoot up higher, and they did shoot up higher, and obviously this was the reaction from the SPX, from equities overall, and it ended with once again the next QRA announcement that we received, when they shifted the issuance to the, well, essentially manipulating the market through the excessive bill issuance. And the QRA announcement on this day was very positive. The amount of issuance came in wildly less than expectations. And what does it mean? This means rates lower, liquidity higher, and SPX absolutely exploding, with rates falling, SPX exploding. Now, same thing. We're beginning to see what we saw right here. Rates higher, break into the positive territory on rates on a trading basis. SPX breaking on a trading basis as well. We believe we will stand right here, and we will be correlated to rates. Rates will be impacted by, once again, CPI, ISMs, and whatever we will do right here with rates will be reflected on the SPX in an inverse manner, meaning rates higher, SPX lower. If rates fall a little bit, SPX will rise, and eventually, if the QRA comes in relatively okay, if they continue to trade in RRP, if they don't surprise with excessive coupon issuance this time, this QRA, liquidity should remain ample. The macro conditions currently are completely fine. Well, not completely fine, right? They are fine. We from 2022, from the liquidity conditions and growth conditions, we coming off from very bad, and now we just stabilizing, and it's more like a calm, more like a stabilization in macro data and everything. Currently, no recession. We are in a quad one. From a macro standpoint, we are in a quad one in Q1 of this year. This is positive as well. All of this, these structural flows, these liquidity points, there's a small catalyst that I pointed out, point to the consolidation right here, which, if all else remains equal, if no new wars begin, I just wanted to say, if no new banks failed, if no, CRE or any other sort of credit event begins, everything will be fine. But if banks fail, if a credit event initiates, it will be even more positive for SPX, as we saw right here, because what will they do again? They will provide even more liquidity and probably stop the QT entirely, and we will see the same thing we saw right here. So this is fine. The biggest risks currently. Oh yeah, and let me finish that thought. So consolidation, if all remains equal, QRA comes in fine, then at the end of the day, in February or in March or in May or in the first months of this the second quarter, we will begin to break out to the upside again, as we saw right here, just like right here. Mind you, this is a very meaningful level that we are touching now. This is the all-time high that we're talking about, and it takes time to break it. So this is the map, this is the thinking, our thinking behind the current conditions and behind what we should do with CPI, what we should do on a trading basis, what we should do with the high frequency trades, and what we should do on a trending basis. Once again, trending bases remain positive. Everything can change in one day, literally. That's why we updating our Bayesian model and looking at everything all at the same time every single day. But this is the underlying conditions, and that's it. This is what I wanted to point out. Once again, let's go through this. Our model outcome is for consolidation, downward sloping consolidation for SPX in that region. However long it will be, we do not know. I do believe we will not get a break upward, meaningful break upward, until we get the QRA announcement anyway. So we're probably not going anywhere by the end of this month, at least. So this is the outlook, let's say, for the upcoming month, a downward sloping consolidation for SPX. We do not see, this is not our base case scenario, that SPX will break lower right here. There is always a possibility that this consolidation may come in a form of a more violent swings and violent retracements. But if it does happen, if let's say something happens, I just don't see what it can be. Maybe the CPI, but meaningful and fast resurgence in CPI can be very detrimental. But it will not happen unless we get a serious oil spike, and because we're monitoring the oil prices daily and the range right there and the signal right there, there is no signal, not at all, not a single jinx of signal that we're gonna get a massive oil spike right now. So that is just off the map currently. But if we are getting something like this is still meant to be bought, especially if we fall fast on a trading basis into the 4300s. This is would be a very significant buy for us. But the model outcome, as I've just described, is this range right here, and a potential creation of a trending high-low, as we've seen in and around this area. Might not look like this again, but most likely it will take form of a more violent and volatile consolidation. But this is a buy. What we begin to do is we begin to add to our trending positions once again, with this expectation that eventually over the next 2, 3, 4 months, we will see this move higher into the 48, 49 hundreds on SPX. But no buts. This is it. I can expand on that for hours and hours. Next, this video will be tied only to that post that we just made, and the next video we will go in depth on our positioning and on our cross asset class analysis, and we go through the whole spectrum and complex of things. Okay.